According to Charlie Munger, the renowned billionaire investor and vice chairman of Berkshire Hathaway, the first $100,000 is the hardest sum to accumulate. This belief is shared by numerous wealthy individuals who find that reaching the first $1 million is also a difficult feat. However, once the $1 million mark is reached, the second million seems to come quickly and takes significantly less time than the first. For those who are concerned about their slow-growing wealth, it is comforting to know that it may become easier to accumulate after reaching certain financial milestones. However, what causes this phenomenon, and how can you accelerate your path to wealth? Let's examine the reasons behind this trend and explore actionable steps that can help you become wealthy sooner. Starting to invest can be a daunting task for many individuals, often considered a low priority and put on the back burner. However, procrastination can lead to an uncertain financial future, leaving one scratching their head about retirement. How many people do you know who would invest if they had more money? This mindset creates a cycle of delay that prevents people from reaching their financial goals. It's important to realize that you don't invest because you have too much money, but because you want to earn more. Fear of risk is another common excuse that holds people back from investing. However, avoiding investment entirely can be riskier in the long run. Similar to many things in life, taking the first step can be the most challenging aspect of investing. When the finish line seems distant, it's tempting to postpone the effort to some future time. Building the first $100,000 requires you to put in significant effort, with most of the money coming from your personal contributions. Once your portfolio grows to a substantial size, compound interest starts to work its magic. Although the percentage returns may not necessarily increase, the returns in terms of dollars become much larger, thanks to the power of compounding. For instance, let's say you invest $5,000 and earn a 10% return in a year. That amounts to a mere $500, which is barely noticeable. In comparison, an investment of $100,000 earning a 10% return is $10,000, which is a substantial sum that can serve as a good starting point for replacing your salary. And when your portfolio reaches $1 million, a 10% annual return is $100,000, a sizable amount that exceeds the income of many people's jobs. Witnessing such significant growth can be thrilling. And it's no wonder that investors often feel a sense of progress when their portfolio hits the $100,000 mark. Once your investments start to grow and compound, the momentum builds up and the rate of growth accelerates. This progress can be incredibly satisfying and motivating, prompting you to seek out more ways to increase your portfolio even faster. You may find yourself looking for ways to increase your income, so you can contribute more to your investments, or researching investment opportunities that offer better returns. The more your investments grow, the more opportunities become available to you, and the more motivated you become to keep growing your wealth. Instead of spending $100 on a meal out, you might think twice after realizing the power of compound interest. Knowing how much that $100 could grow and continue to reward you if invested, it becomes harder to part with. For example, that $100 spent on a meal out is gone forever, but if invested, it could earn $10 in the first year, $11 in the second year, and $12 in the third year. While $100 may not seem like a large amount of money, the habit of saving $100 regularly in different categories can add up over time. As you accumulate more wealth, you gain more options and opportunities that may not be available to those who live paycheck to paycheck. For instance, with a savings of $100,000, you can take risks, such as switching to a job with high potential income or room for growth, even if the payment is not steady. For example, if your current job pays $50,000 per year, but commission-only opportunity arises that is likely to pay $100,000 or more per year, having savings can enable you to take that risk. Without savings, taking such risks may not be practical or feasible. It could be that you've long desired to start a business, but the lack of capital or a financial cushion has held you back. Such a business might potentially earn you millions of dollars, but without the means to start it, the opportunity would be lost. There may be instances where an amazing chance to invest in real estate arises, such as buying a home significantly below market value, but it comes with a high level of risk. However, having savings means that you have the option to take that risk. While it's not always advisable to liquidate your investments, having a decent amount of savings provides you with that choice, especially when a once-in-a-lifetime opportunity presents itself. Someone with minimal savings would be much more limited in their options. You can take more risks with your investments when you have more money. This means that you can invest in things that might have a higher potential return, but also had a higher potential risk. For example, you might invest in a stock that you think has a lot of potentials, even though it's riskier. If it doesn't work out, you'll still have other investments to fall back on. Additionally, suppose a friend presents you with an opportunity to invest in a new business venture. In that case, you'll have the ability to invest without worrying about it ruining you financially if it doesn't work out. People with little money saved don't have the same options to invest in these kinds of opportunities. If you're still striving to reach the milestone of saving $100,000, there are ways to expedite the process without running into legal or ethical issues. Since most of the funds you'll save will come from your own contributions, your focus should be on increasing the amount you save regularly. This is the most effective way to accelerate your savings. To save more, you'll need to increase your income. One option is to take on a second job during weekends or a few nights a week and deposit the extra earnings directly into your savings account. You could also start a side business to generate extra income. It's important to be cautious when spending money on non-essential items. Consider if you truly want to spend a significant amount on a dinner out, or if it would be better to save that money for more important goals. Keep in mind that being mindful of your spending habits is only a temporary measure until you achieve your financial objectives, and you can relax a little once you get there. Avoid taking on large car payments for vehicles that you don't really need. Overspending on cars is one of the common reasons why many people fail to reach their financial goals, including accumulating $100,000 or more in savings. Consider opting for a more affordable car that meets your basic needs and redirect the money you save towards building your wealth. After you have developed a habit of saving and investing, it becomes easier to keep doing so. By the time you accumulate a considerable amount of money, you will be accustomed to discovering ways to earn additional income and depositing it into your savings. As you continue to save and invest, you'll develop a habit of being more intentional with your spending. You'll start considering if a purchase is necessary or if saving that money would be more beneficial. You'll also become more comfortable with taking risks in investing and even learn how to take advantage of market fluctuations. Eventually, this will become second nature, and you'll have a better chance of achieving your financial goals. After hitting the $100,000 target, Charlie Munger suggests taking a breather. While the next milestone of $1 million might seem daunting, the journey becomes easier as a larger portion of your investments will be fueled by compound interest instead of just your own contributions. So next time you feel overwhelmed about increasing your net worth, remember that it gets simpler, more satisfying, and more gratifying as time passes.